Hi, welcome back. In this lecture, we will go through part 1 of the efficiency ratios, where we will walk through the asset turnover ratio. On this slide, we will now calculate the asset turnover ratio for Amazon. So, what is the asset turnover ratio and why is it important? Well, the asset turnover ratio helps investors understand how effectively companies are using their assets to generate sales. This is calculated as the ratio of total sales over average assets. Investors use this ratio to compare similar companies in the same sector or group. The key point here is that the higher the asset turnover ratio, the better the company is performing, since it indicates that the company is generating more revenue per dollar of asset. So, how is this ratio calculated? The asset turnover ratio is calculated by taking the total revenues during the year and dividing this by the average total assets. For Amazon, we find that the revenues was $280.5 billion, and the average total assets was $193.9 billion. And that's calculated as taking the total assets for 2018 and 2019 and dividing that by 2. And once you take those amounts, we come up with an asset turnover ratio of 1.45. So what does this mean? This tells us that Amazon is able to generate approximately 1.45 times of sales from its average asset balance. In other words, Amazon is able to generate approximately $1.45 per year for every dollar of asset it owns on its books. Now, we will calculate the asset turnover ratio for Walmart. Using the same formula, we find total revenues for fiscal 2020 was $523.9 billion. And then we'll calculate the average total assets by taking the ending total assets for fiscal 2019 and fiscal 2020. So the average total assets is $193.9 billion. And once we take those amounts, we come up with an asset turnover ratio of 2.30. So now what does this mean and how does it compare to what we saw at Amazon? Well, this tells us that Walmart is able to generate around $2.30 per year for every dollar of asset it owns on its books. When we compare Walmart to Amazon, we can see based on this ratio that Walmart is actually more efficient than Amazon when it comes to generating revenues from its assets. Hi, welcome back. In this lecture, we will go through part 2 of the efficiency ratios, where we will walk through the inventory turnover ratio. On this slide, we will now calculate the inventory turnover ratio for Amazon. So, what is the inventory turnover ratio and why is it important? Well, this ratio tells us how many times a company sells its inventory during the period. The key point here is that a higher inventory turnover ratio is better, since it typically means a company is selling its products more quickly, which indicates that there is demand for their products. So how is this ratio calculated? Inventory turnover is calculated by taking the company's cost of goods sold and dividing this by its average inventory during the year. To start, we can see that Amazon had cost of sales of $165.5 billion. And then we take the average inventory of $18.8 billion. And that's calculated by taking the ending inventory for fiscal 2018 and 2019 and dividing that by 2. And now once we take those amounts, we come up with an inventory turnover ratio of 8.79. So what does this mean? This tells us that Amazon sells its inventory balance approximately 8.8 times every year. Now on this slide, we will calculate the inventory turnover ratio for Walmart. We'll use the same formula, and now we'll start with the cost of goods sold. Here, we can see cost of sales for Walmart was $394.6 billion for fiscal 2020. And then we calculate the average total asset balance by taking the ending inventory for fiscal 2019 and fiscal 2020, which comes out to around $44.3 billion. Once we take those amounts, we come up with an inventory turnover ratio of 8.90 for Walmart. Now, what does this mean, and how does it compare to Amazon? Well, this tells us Walmart sells its inventory balance approximately 8.9 times every year. As compared to Amazon, we can see that Walmart actually turns its inventory slightly more frequently than Amazon. In other words, Walmart sells its inventory more quickly than Amazon, which indicates that it is slightly more efficient than Amazon when it comes to its inventory management. Welcome back. In this lecture, we will go through part 3 of the efficiency ratios, where we will walk through the receivables turnover ratio. On this slide, we will now calculate the receivables turnover ratio for Amazon. What is the receivables turnover ratio and why is it important? Well, this ratio tells us the company's effectiveness in collecting its receivables from its customers. Typically, a high receivables turnover ratio indicates that a company's collection of accounts receivable is efficient and that the company has a high proportion of quality customers that pay their debts quickly. In contrast, a low receivables turnover ratio may indicate that the company may have lower quality customers or that the company has a poor collection or bad credit process. So how is this ratio calculated? This is calculated by simply taking the net sales during the year and dividing that amount by the average accounts receivable balance. For Amazon, we find its net sales of $280.5 billion. We then calculate its average AR balance of $18.7 billion. And that gives us a receivables turnover ratio of just under 15. Well, what does this tell us? This tells us that Amazon is able to collect its average accounts receivable balance from its customers around 15 times per year, or 14.96 to be exact. On this slide, we'll now calculate the receivables turnover ratio for Walmart. Using the same calculation, we'll start with its net sales of $523.9 billion for fiscal 2020. And then we locate its accounts receivable balance, which averages to around $6.3 billion for fiscal 2019 and fiscal 2020. and that gives us a receivables turnover ratio of around 83.39. Now, what is this telling us? Well, this tells us that Amazon has a relatively small accounts receivable balance as compared to its sales. For example, Walmart turns its receivables balance approximately 83 times a year. When we compare this to Amazon, we can see that Walmart's receivables turnover ratio is higher, which makes sense considering that the majority of Walmart's sales are still made in its physical stores. In other words, Walmart is more efficient than Amazon when it comes to collecting its receivables balances. We will now go through the scorecard for the efficiency ratios for Amazon and Walmart. First, we calculated an inventory turnover ratio of 8.79 for Amazon versus 8.90 for Walmart. So in this case, Walmart has the slight advantage with its inventory turnover ratio. Next, we saw that Amazon had an asset turnover ratio of 1.45 versus 2.30 for Walmart. So in that case, Walmart has the advantage for the asset turnover ratio. And last, we saw a receivables turnover ratio of around 14.96 for Amazon versus 83.39 for Walmart. So again, Amazon takes the advantage for the receivables turnover ratio. So to summarize this section, we can see that Walmart has better efficiency ratios when it comes to its business.